Greg, Foss, welcome back, man. How are you?
Well, I'm so excited to be back, and I'm doing well, thanks, Peter. Nice to have
Dude,
met you in person in Miami. It was really a great experience.
dude, Miami was awesome. I had such a good time. It was great to meet you too. Dylan, first appearance on the show. How you feeling, brother?
Feeling awesome. Thanks for having me on. Long time listener, so happy to make it on here.
Well, listen, you wrote such a good article. We had to get you on. We had to talk about this, but also it's good to have Greg to join us. Um, you both know the show. You both know the way I do things. I like to keep things like nice and simple for easy for people to understand. But this was great timing, your article, because I think it came after I'd watched Ray Dalio's video, probably for about the fifth time. But I'd seen it around the time you wrote this, because every time I'm like just trying to see where we're going or kind of understand what's going on, I go and watch that video, and then I'm like, oh shit, we're absolutely fucked. But that video is brilliant. Explanations brilliant. I'm going to stick a link into the show notes so people go and check it out. It is called "Conclusion of the Long-Term Debt Cycle and the Rise of Bitcoin," and it appears we are coming to the conclusion of the long-term debt cycle. But Dylan, look, just welcome yourself. Explain to people who you are, and then talk about why you approach this article because it's a bit of a beast.
Yeah. So my name is Dylan LeClair. I work for Bitcoin Magazine. Started up with them like about 5 months ago. Didn't really start doing content, but more like media stuff. But yeah, started there. Dropped out of school about a year ago. Like have a business called 21st Paradigm where I kind of consult people about Bitcoin and why it's important, why they need it. So yeah, it's been kind of a crazy year. Life's changed a lot, but yeah, I think in around April, I put out this piece called the conclusion of the long term debt cycle and the rise of Bitcoin. After reading a lot of Ray Dalio, his work, he has like a pretty long book, which is kind of like lays this out. It's like kind of how he made his career, honestly. And I also have watched that like 30-minute video multiple times. You'll probably learn more in that video than you will, from a college economics degree, to be honest. So everyone should go watch that at the very least.
Dude, I send that video to so many people. I've stuck it on Facebook. I've told my friends, listen, you need to watch this. You need to understand what's going on in the economy. I think I learned more about economics in that than the 2 years I did studying economics for A level. I think you're absolutely fucking right. It's such an unbelievably condensed video of how the economy works. But I do want to ask you, could you said you dropped out of school. All the smartest people drop out of school. They realize it's bullshit for some reason. What were you studying and why did you drop out?
Yeah, I was studying business. Like been a numbers guy kind of my entire life, but was like kind of had to focus on like finance and econ. It was like learning Keynesian economics, and at the same time, I'm listening to a bunch of podcasts and reading and doing all this stuff on the side for free. And they sent us home because of COVID, and it was like the contrast between like Zoom University taught by a bunch of boomers and like free podcast like free podcasts and Bitcoin Twitter were like couldn't be more, the contrast couldn't be more stark. So I dropped out and just picked up a job and to stack as many sats as I could. And about 6 8 and I think about 9 months later I landed a job here. So worked out well.
Avoid all that college debt.
Yeah, for sure.
Good move, brother. Greg, you must love this video as well. You must know the Ray Dalio video.
Yes, sir. I wanted to. I do, and I've followed Mr. Dalio's career. Well, shouldn't say follow it. We tried to mimic it at the hedge funds I worked at. Certainly, his risk parity platform was brilliant. It actually doesn't work anymore. He knows it because interest rates don't go from 14 to zero and then from zero to minus 14%. Okay. So the 10-year over my career and his career, US 10-year went from 14% down to just under 1%. And that works great when you use bonds as a hedge against the volatility in equity markets. But mathematics, bonds are only mathematics, and the math doesn't work when you go below zero. Mr. Dalio knows that, and so most famously, he said, "I'd rather own Bitcoin
Mm-hmm.
than a bond." And Mr. Dalio shows that he understands math, and he's trying to tell other people to study math, but unfortunately, they're looking backwards. They're driving in the rearview mirror. So, but can I add one thing? So I met Dylan down in Miami, first time. And just before we went on stage, Dylan tells me, I go, why did you drop out of UVM? And he goes, because I was sick of the Keynesian brainwashing. And that line has stuck with me since I met you, Dylan. Because it becomes a bit of a brainwashing. Everyone accepts the curriculum as being gospel, and the truth is, no true academics have ever sat in a risk chair where they've traded risk as a career, and they'll quickly realize that what you learn in a textbook versus what you learn sitting in a risk chair like Mr. Dalio's done, two very different lives. And there's theory, there's practice. Sometimes the two intersect, and sometimes they do not intersect. Uh, this is what makes life exciting. And if you sit in an academic chair like Steve Hanke does, I would suggest you just wrap his research in fish, okay? Or the flip side, I wouldn't use his research to wrap fish, quite honestly. So take Mr. Dalio at face value. Take young kids like Dylan, who've seen who question the system. And just want to say that that's what gives me strength is meeting uh, young men like Dylan who's decided to take his education under his own wing and go with it. So proud to be here, boys.
Appreciate the kind words.
Yeah, good work, Dylan. I'm in the same challenge with my own children now. I've really come to question a lot about the education they're getting, and I try and teach them my own things, and like we're making progress. Luckily, my son is an art student, so there's not too much propaganda involved in that, as long as he avoids some of the woke elite. But there's a couple of interesting points you made there I want to touch on, actually, because one of the things I find really interesting about Ray Dalio, he seemed to not get Bitcoin for quite some time. But like he put that tweet out that time, he said, you know what, I could be wrong about this. I might, need to reconsider my position. He kind of put himself out there and admitted it, and looked like he went and kind of changed position. And it feels like there's a lot of people out there who just don't want to do that. They've like got this, it's almost like this sunk cost. If I've been so against Bitcoin, I've got to stay against Bitcoin. And someone like that, that really sticks out is Hanke. I've been replying. I've been a bit of a reply guy for the last 2 weeks, because he keeps tweeting about various countries. I think it's like Ethiopia and Lebanon and the currency crisis that's happening. I just keep saying, I don't understand how you don't understand Bitcoin when you're posting this shit. Like, it's almost like he feels like the solution is within the current system, but he refuses to accept that maybe Bitcoin can be an answer. So he'll post about Ethiopia's inflation, or he'll post about Lebanon's inflation rate and currency collapse, and then the next post will be something very anti-Bitcoin. I don't understand why he won't just even make an attempt to understand Bitcoin. It's a really strange position.
Most ironic thing is that he has troubled currency project in his bio. Like that's like, one of the things he does. And he said, think about El Salvador. He said the most prudent thing they could do is elect a currency board. It's like, I think you just have to take opinions from guys like Hanke just with a grain of salt at this point. Just ignore them. I mean, like being a reply guy's fun. I do it too. But
Uh-huh. The truth is, guys, the best risk managers in the world, of which Ray Dalio is obviously one of them, they change their
Yeah.
positions when the facts change, right? Anybody who sticks to a position that's costing them money will get carried out on a gurney off the trading floor or out of the hedge fund business, right? And this is what Hanke doesn't understand. It's what, I don't want to bring up Peter Schiff's name, but it's like these people. You can see when conflict enters the situation or enters the discussion, meaning, I'm a gold bug and I won't promote a better alternative. But then Mr. Dalio's honest as the day is long. He says, I could be wrong. Well, so could all of us be wrong. At least admit that. Whereas other people who are dogmatically opposed to it because they've done their 3 hours of research on it, my goodness, this isn't even funny. Matt Odell tweeted the other day, anybody who pretends they truly understand Bitcoin is either lying to themselves or lying to other people. And that's the truth. I mean, how long have you guys been studying it and continue to learn new things about it and see the network and the lightning layer too and all this stuff? You can't possibly claim to learn it after only studying it for 5 years, which I've been, to be an expert in it for 5 years, which I've been doing. It's impossible. You continue to learn new stuff. So people who categorically dismiss it as I looked at it for 3 hours and this is not
It's
going to
too
work.
volatile.
You can't listen to people like
It's
that.
too volatile.
Well, that volatility is the price of return. You want volatility. As a trader, you love volatility. I don't get it. People just don't, as if they put 3% in their portfolio and they forget about the other 97% of their portfolio. It's that 3% that's going to absolutely, define their careers. That's exactly wrong. And that's what Mr. Dalio understands. And I wanted to point out one thing, Peter. I think at the beginning, it would have been impossible for Bridgewater to embrace Bitcoin before it got over, a $500 billion market cap sort of thing. It's just not a big enough market for the size of the fund that Ray runs. And they need liquidity. They need long shorts. They need to be able to move in and amass a position. And it's like anything. Sometimes when a small cap company is just too small, it might be the best investment in the world, and their analysts might agree that it is. But to get a position size that would matter in their portfolio, that just can't happen in many cases. So Bitcoin is now in the big boys league, and you'll be surprised. I just got off the phone, or it was a Zoom call 2 days ago with a very large family office in New Jersey, a kid I went to school with. 30 years he's been building his business, and he's finally come around to realizing they need to consider Bitcoin as a portfolio addition. And look, if they're doing it, I promise you all other quantitatively inclined accounts are looking at it as well. And volatility is good. You got to understand, volatility is the price of return.
Well, I know, man. I know. I mean, look, it's probably for another show that there is an issue with volatility as someone like El Salvador
Correct.
accepts it as
Correct.
a medium exchange.
Yeah.
People have to think about it, but that's about risk management and teaching risk management. But like your other point, reference to Matt Odell. Listen, in some ways I am the luckiest Bitcoiner in the all of Bitcoin, because every week I get to speak to the smartest fucking people, and I get to ask them all the questions that I want answered, and I still don't know shit, and I accept that. Mm-hmm. So listen, you make a really good point there. But listen, we're gonna make you the star of the show today, Dylan. Me and Greg are we're the boomers that kind of get Bitcoin a little bit, but you're the youngster here.
Yep.
Your age probably starts with a 2. You're still handsome. You probably kill it on Tinder. So listen, we're gonna go ahead with you. Let's work through this. So there will be people who won't have watched the Ray Dalio video. We'll tell them to watch it, and they still won't watch it. We'll put it in the show notes, and they'll still won't watch it. So, like, for those, we need to work through it anyway. Let's talk about this long-term debt cycle, how we get there, etc., etc. We're essentially talking about money we borrow from ourselves.
Yeah. So, like, many people think when you think just like borrowing, right? People think like borrowing from someone else, but in the most basic sense, when you borrow money, you're borrowing from your future self. You're pulling productivity forward. Right. So like, whether at an individual level, right, you just, you borrow $100 and you have to pay it back plus interest. You spend that money today, or you invest it, or whatever you do with the money, you have to pay that back with your future productivity. And many people don't think of it like that, but that holds true at an individual level. Like everybody can kind of grasp that, but it also holds true at a macroeconomic level. Whether it's an industry or a sector or a nation or the whole world, right? And so debt, because of that, debt is cyclical. And so you see this play out over 8 to 10 year periods, and you also see this play out at over 80 to 100 year periods, or around there. It's kind of an estimate, but and then these kind of cycles play out because debt is cyclical.
Right. So to help somebody understand that, when you're saying you're borrowing from yourself, it's because in the future, if you're borrowing money now, say like to buy a car, and then you got to pay for that car back plus the interest. A lot of people will do something based on the fact they think, look, my career is going to grow, I'm going to earn more money, this is cool, this is fine, I'll be able to support it. But if your wages are stagnant during that period, that's where it actually becomes difficult for yourself on an individual level, because you suddenly become burdened with this debt, and that means your spending power of what you earn in the future is going to be decreased. So you're putting a bit of pressure on yourself. Let's try and like extrapolate that out and think in terms of like the entire economy, why we get to these boom and bust cycles. And listen, when I grew up and I studied Keynesian economics, we'd study boom and bust cycles, right? But these bust cycles, like we had the 2008 crisis, and now we've got what appears to be a bigger crisis. It feels like this whole let's call it short-term debt cycle moving into a long-term debt cycle is becoming something like it's going to get quite out of hand. For me, right now, I look at all the different points in your articles. You raise the issue of the rise of populism, the wage differential, the fact that you'll see uprising. And I only literally tweeted, I think yesterday, it feels like we've got a protest in every fucking country in the world right now.
Yeah, I mean that's not coincidence, right? I mean, so like you have these debt cycles, and in the short term, right? Because of you're pulling demand forward on the upswing of a credit expansion. It's kind of like a self reinforcing like upwards boom, right? You pull forward demand. If that debt is used for investment or it gets a positive return, that's a good thing. Like debt isn't always a bad thing. If you use debt to increase your income, right? Like be it if you borrow some money and you hire a producer, with money that you didn't have before. That's actually good and increases your productivity. But many people, especially kind of during the later state or like the bubble phase of a debt cycle, they use that debt for unproductive things. I'm going to go use that debt and I'm going to buy a car because it's cool and it makes me feel good. Or I'm going to go use that debt to, whatever, gamble. It could be anything. And
Buy some nice
that debt
clothes.
is bad debt. Yeah. And so kind of and people in these upswings feel richer, right? You borrow money, your the asset value raised because you have more assets, you're more credit worthy, you have more collateral, and this kind of occurs, at a national scale or a global scale. And so over the course of, there's these like people are kind of intuitively understand whether or not like they're an economist or not. They understand like the business cycle, right? Like, oh, times are good, everyone's productive. And, once every 10 years or back in 2008, there was a recession that maybe people don't really understand why or that it's driven by credit, but they understand that, maybe once every 10 years, there's good times and then there's bad times and there's a recession and things get a little hard. People don't really, kind of understand the driving forces behind that. But, in 2008, 2000 or 2020, we have these recessions. But over the course of the last 40 years, interest rates have gone in the U.S. from 20% in or around there in 1981 to zero today, right? So anybody that's holding an asset, Greg talks about credit a lot. If you hold the long bond or you're just a bond investor from 1981 to 2020, you just sit on your hands essentially. I mean, there's more to it than that, but you know, the present value of all assets when interest rates go from 20% to zero skyrocket. But who's left out of that equation? The wage earners, right? Anybody that doesn't have a bag of assets is kind of getting pillaged. And so this is like a systematic thing. There's not one person to blame. There's not, it's not this person's fault or that person's fault. This is occurring on a global scale, and it's for the most part because of the international monetary order. It's kind of driven by the U.S., but it is a global thing, right? Everybody that the 1%, the rise of populism, all this stuff, like red team versus blue team, Democrats versus Republicans. I mean, it's all just symptoms of the bigger problem here, and that's what like kind of a lot of people don't really understand.
Greg, listen, look, I know we look a similar age, but I think you've got a few years on me. 20% interest rates? That was
That's
a
correct.
thing?
That's when I
You could put
started
money in
in
the bank?
1982
Well, I was
when
4.
Volcker. Okay, so I was 20. So there you go. So to be exact, I was 19.
You,
But
you're
yeah,
not 58.
1982. I am 58, sir. So
Damn.
the good thing is, yes, it was 20% interest rates, and Volcker needed to snuff out inflation. And he succeeded. Now you can do that mathematically when you don't have a debt burden that we have today. Okay. And so there's Dylan, I love the way you talk about pulling things forward. Look, all a bond is a contractual obligation. And everyone said, oh my God, I made so much money in bonds on a capital gains basis. But really, when interest rates go from 20 down to 1%, and let's say you cash in that 30-year bond when interest rates have gone from 20. So you have a coupon on your 30-year bond is a 20% coupon. And in 10 years, you decide with 20 years remaining, I'm going to cash out that 30-year bond. And it's gone up. It's trading like $160 of parity because that's only bond math. And in year 20, though, you take that coupon and rates have gone from 20% down to call it 12%. Um, all you do is you pull forward those the remaining 20 years of 20% coupons. And then you now have a 12% return going forward. So that's the bond math of it, but you can bring it to the same context of borrowing money, because ultimately that's all that a discount rate is it's a measure of it sets the base level of risk. So if your government is borrowing at 12%, everything else is discounted on top of that, right? So equities get discounted, let's say, at 12% plus an equity premium. Corporate bonds get discounted at 12% plus a corporate bond premium, etc. So we've gone from a 20% coupon down to an under in the 10-year down to an under 1% coupon. And then recently,
Greg,
the quintessential. Yeah, hold on, Peter. I want to say this. We had a 30-year bond in 1 year ago. They got issued at a 1.25% coupon. Okay, it's now trading down 30 points, 30 bond points, because interest rates in the 30-year went from
what's 30
1.25%
points?
back up to 2.5%.
Like, what does 30 points mean?
30
what does that
bond
mean
points.
to a layman?
Okay, you buy a bond. Sure, you buy a bond at 100 cents on the dollar, because that's generally when it gets issued. It gets issued at 100 cents on the dollar, and it traded down to 70 cents. This is supposed to be capital preservation in bonds, and you buy a bond 1 year ago at 100 cents on the dollar with a 1.25 coupon on it in the 30-year, and now it's trading down 20 points or 25 points because interest rates have gone from 1.25 to 2.5, and then back to 2% in the 30-year. It's all rounding errors from basis points, Peter, but that's the real life impact on the price of your bond.
Did I just see Australia sell $100 million of bonds, 10-year bonds or something, at -1%?
You did, sir.
It's laughable.
Okay,
it's laughable.
I mean, I'm trying to be rational here, but that sounds fucked up. Okay, so basically, I'm trying to think, why rationally would you do that? If you have an expectation inflation's going to be high, there's actually might be a good trade, right?
It's good for the seller. But, the seller of bonds at a negative yield means it's turned into that liability from the seller is now an asset, because they issue bonds at 100 cents on the dollar, and they only have to pay 98 to get their to eliminate the principal obligation. It's mathematics with
But
a
they found
negative
buyers.
yield. Pardon me?
But they found buyers, right?
Greg, maybe you can speak more on this, but I imagine a lot of the buyers of those bonds are probably mandated to buy them. No?
Oh, they are mandated, guys, but it's a liability.
Yeah.
It's no longer an asset. They are mandated to lose money. That's a contractual obligation to lose money before inflation expectations are even priced in. Peter, it's crazy. I know you get it. It's like I lent this guy $100 and he's going to give me $98 back, and I'm going to be happy about this. What the heck?
Well,
are you kidding me? This is ridiculous.
Look, I wrote down one line specifically from Dylan's article, and it just makes me think of this. There is mathematically no way out of the current economic environment. It's just the signal is there that we are in some kind of absolute fucked position. And it's like, so what I care about is like, okay, look, we're all screwed. How's this going to play out? Is Lebanon, is that a lens into the future for us in Europe and the US, or will Europe and the US have high inflation, but certainly not a situation like they've had there? Like, I'm in my head, I'm trying to think how this plays out, because hyperinflationary events are things that happen in countries like Venezuela and Zimbabwe. They don't happen in the UK for me. Like, I'm like, no, that's not going to happen. Of course it's not. Like,
until they do.
Well, until they do. But like, I don't know, Dylan. Look, you've got it in your article. This long-term debt cycle is coming to end. How does it all end?
Yeah, so I mean, like, how we got here, right, is like, these short-term debt cycles. It's like, the 8 to 10 years, like we talked about. It's essentially like debt-to-income ratios reach an unsustainable level. What happens? All of the malinvestment, all of the misallocation of capital in a capitalistic system would get wiped out, right? But what happens?
Which is not a bad thing, by the way.
No, it's a
Creative destruction.
yeah.
It's called creative destruction, guys. It's supposed to happen.
Yeah, it's a great thing, right? It's just like, it's just, but you have what, like I covered in the article, what we have now is, I mean, in the US, there's a semblance of capitalism, right? But 50% of every transaction is money, right? And the price of money is centrally planned. The price of money is not, it's really, we haven't had capitalism. The price of money, interest rates, has been centrally planned. So every time we kind of have started to have some sort of deleveraging where, anybody that was kind of, over leveraged or out of position, they would get wiped out. Well, what happens? Central banks come in, they lower the price of money. It's essentially a bailout, and it's happened at a greater and greater scale as these debt cycles come along, right? And
Socializing losses, Dylan. That's exactly what you call it. You call it socializing losses. So long-term capital management in 1998. A total example of Wall Street getting bailed out using crony capitalism, socializing the losses, and eventually that financial burden gets transferred to the burden of the balance sheets of the Fed, which ultimately is the citizens. Okay.
Greg, is that it does all right? A couple of reasons why I think that might happen. Does that happen because it is crony capitalism, or is it voter protection? Is it because we live in this short-term 4-year presidential or prime minister cycle, and therefore they're trying to protect their votes? They kick the can down the road. The next administration can deal with that. Yada yada. Is that what's going on? Which one is it? Is it both?
Beautiful. So it's both. Well,
Right.
it's both. And here's what I'm going to add to it, though. This is cool. Dylan was totally right, because it's only math, Peter. Now it's only math. Before, there was a time when we could have, bailed out the great financial crisis in 2008, 2009. The financial burden was transferred from the financial system to the balance sheet of the Fed. If we had been prudent, and I say we, as because every single country was in the same situation, ECB, the Bank of Canada. If we had paid down that debt prudently, and it would have cost an administration their votes, because you go into power and you say, yeah, you know what, guys, the prior administrations have pulled forward too much demand, so we're going to pay it down now, and it's going to be hard. We're going to pay it down. Growth is going to suffer because we're not having the ever expanding debt balloon to fund deficits, etc. We're going to pay it down, but we're going to be prudent for our children. You think the guy's going to be in power in the next 4 years after that? Not even close. All right. So they don't do it. And they continue to kick the can down the road, like you said. And now mathematically, as Dylan said, it is now impossible to reach a growth rate in the global economy that will service your debt and not allow that debt balloon just to expand organically because of the coupon on that debt. Dylan nailed it. It's math, guys. Very simple.
Well, I got two more questions. Like, I'll throw this one at you, Dylan, and then you can feel free to pass it back to Greg if you want. But should 2008 that have been the end of the long-term debt cycle? Because as I think I remember it, the bailout was around 800 million, which right now actually doesn't seem like that much money compared to what's happened. The trillions we're seeing printed right now. The 800 million doesn't seem like that big a bailout, but it feels like perhaps, what happened in 2008, that was the end of the long-term cycle.
Yeah, so it's actually kind of funny when you watch Ray Dalio's video. He made that 30-minute video that we were talking about at the beginning. Like, he made that in, I think, 2011 or 12 or 13. He actually referred to that as kind of the end of the long-term debt cycle. Like interest rates at zero, and he kind of walked through the logical path going forward. So and in Ray Dalio's book, and he kind of talked about this in the video, there's like 3 types of monetary policy. First type of monetary policy is interest rate monetary policy. Like, that's the central bank's like bread and butter, right? That's what they use. It's essentially their lever to kind of control the economy, and to control basically the cost of capital. And so over the last, 40 years, since 1981, it's essentially, debt loads, debt to income levels get too high. What they do, they lower the cost of capital. There's another, 8 to 10 years we coast by, and it happens again, and it happens again. Well, in 2008, interest rates hit zero. It's kind of like a hard floor. And so what do? Well, in order to recapitalize the banking system, in order to stimulate the economy, they move to the second monetary policy, which is QE. So they essentially go into the bond market with freshly printed cash, and they'll say, oh, it's not printing money because we're just replacing $1 of assets with $1 of cash. But that's not that's not really. I think that's kind of
Wrong.
I don't think that's, yeah, it's wrong, to put it nice. Because it's putting a bid in the credit market. That wouldn't actually exist. It's adding liquidity to the system that wouldn't actually exist. And so what they did is they had the TARP bailout. They essentially took a bunch of junk assets off the balance sheets of the banks, and they went in and they're essentially, they weren't doing it to the extent they are today, but they're essentially helped to monetize the deficit. They're essentially giving the government, loans at an interest rate that they wouldn't actually get. And so quantitative easing, when during a liquidity crunch, during kind of a recession, at the beginning of it actually, there is some benefit. I mean, we can argue the merits of it, but when there is this like an illiquidity in the bond market, it actually there's a benefit to it. But with each marginal dollar that is printed, with each marginal dollar that's kind of stuffed into the system, QE becomes less and less and less beneficial, or has less and less of an effect. And so Ray Dalio walks
sorry
through.
to interrupt you, Dylan. Is that why now we're seeing levels of essential money printing right now, which like are vastly higher than what happened in 2008? Is that why it's like trillions now?
Yeah, because like the 600 billion that they did at the TARP bailouts and all of that in 08.
Sorry, I said 800 million earlier. That should have been 800 billion, by the way.
Yeah, I mean that's a drop in the bucket. I mean they're doing 120 billion dollars a month. 40 billion in mortgage-backed securities and 80 billion in treasuries, and that's just the Fed, the ECB, the BOJ. They're all doing it, and that's just kind of like the logical conclusion, or like the logical path forward for a central bank. That's kind of how a debt cycle goes on, and they really don't have a choice because we're in a purely fiat system. Like back in 1929, there was this big private debt bubble after the Roaring Twenties, but we were on a gold peg, so they really couldn't go in and just essentially, for lack of a better term, print money, because there was a gold backing. That all of that huge debt bubble could collapse back onto a gold peg, right? Gold was kind of that bearer instrument that all the malinvestment and all the bad debt could collapse back onto. Well, now we're in a fiat system, and Greg talks about it, and he nails it. He knows the math better than I do, but fiat is created through lending, and it's destroyed through default or repayment, right? So when I lend you or Greg $100 plus interest, I now have $100, $105 asset. Greg has the cash and a liability. That actually commercial bank lending creates money. And so when that money can't be repaid back, it all collapses down. The asset I thought I had, well, it's not there anymore. Greg, whatever he did with the money, and so all of this, it just kind of collapses down. My asset, I don't have it. I'm not as credit worthy. I can't go lend or I can't go borrow any money because I don't have any assets. And it just kind of spirals all the way down, literally to zero. I mean, maybe that's an over-exaggeration, but they can't let it unwind. It's number one, it's not politically feasible, right? You're not going to get elected. You're not going to go up as a central banker and let everything collapse around you. But two, like literally the system can't, like credit has to expand or else everything, goes to all hell.
Again, it's mathematics. Dylan nails it. It's beautiful. I just want to add one thing. The fiat currency is now the error term that solves the growth in the numerator, which is your total global debt, versus the denominator, which is total global GDP. And we have reached a point of no return where the numerator is going to outstrip the growth of the denominator under any plausible scenario, which means you need to print money to solve that debt spiral. Again, Peter, it's only mathematics. Gosh, grade 11 math students would understand this if they actually were taught in school. But you don't teach this in school because it exposes the fiat Ponzi.
Yeah, there's four ways out of a big debt crisis. And Dalio lays this out. And for me, this was kind of a light bulb moment. Like I was reading his book last March, and it was really like, whoa, that's kind of when I realized there's no alternative to Bitcoin. It's like there's four ways out of a long-term debt cycle or a big debt crisis. Austerity, so spending less money, debt default or restructurings, transfers of money and credit from the haves to the have-nots, or printing money, essentially quantitative easing, printing money, whatever you want to call it, bank
Well,
recapitalization.
the first three are hugely unpopular with immediate effect.
Yeah.
The last one is the kick in the can down the road.
Yeah, the last one is it makes asset holders feel good, and Ray Dalio, when he lays out his 3 different types of monetary policy, the third one is stimulus checks. Basically money to the people. You can call it, now it's called UBI, or I guess MMT may fall in this bucket, right? You can get more, create, quote unquote, create more jobs, or do like the theories of Stephanie Kelton and all of this.
I was just about to say the school of Stephanie Kelton. I've had her on the show, man, and like I tried to hold my own.
I listened to that episode.
Right,
it was pretty brutal. I can't lie.
Yeah. I think I did okay. I was like, I couldn't get her on the same page as me, and I was like willing to give her the time. But I was like, look, you're living in a fucking dream world.
Yeah, it is, right. It's living in a dream world with that. It's not capitalism, and so these first 3 kind of like ways out of a debt crisis just aren't going to happen. What's going to happen? It's going to be
Elizabeth
because
Warren's talked about the wealth tax.
Well, have fun taxing my Bitcoin that I keep in my head.
Well played, brother. Well played.
Mm-hmm. But also, listen, even you can raise taxes. There would be a point of diminishing returns, right? You raise your tax rate high enough, the diminishing marginal return in the tax base, because more of the economy goes underground, etc. One of the things that Stephanie Kelton obviously doesn't understand is mathematics. Again, we just have to look at the simplistic size of the debt balloon versus the ability of the economy to produce enough growth to keep up with the growth of the interest coupon, your debt service obligation. It doesn't work. Therefore, you have to keep printing money to solve the circularity of this. It's like an error. I call it the error term, but think of it as circular value. You remember in Lotus 1, 2, 3? You probably don't, but they used to, if you formulated reformatted a cell and you built a cell on top of itself, they would give you an error in the bottom left-hand corner. Circular logic. Well, that's what MMT is. It's circular logic. It does not friggin' work. Okay? And
Lotus 1, 2, 3.
Do you remember Lotus 1, 2, 3?
Isn't that like pre-Excel?
It was brilliant. It was pre-Excel, but then Microsoft, took the code and combined it with WordPerfect, there was Lotus 1, 2, 3 and WordPerfect, and now there's Word and Excel, and they're both in the Microsoft suite, and they talk to each other perfectly. And all of a sudden, Lotus 1, 2, 3 was like, okay, done. But there was a day when you programmed in Lotus 1, 2, 3 because that was the spreadsheet language. I sort of was okay at it, but that's dating me because it was pre 2000, right? So, but this is neat. Dylan's right. Think about this. It's all about collateral values. A bank can lend against collateral that's appreciating in value because a bank is so levered itself. It needs to see appreciating collateral values in the economy in order to increase its lending base as well. So, Dylan, you're nailing it on all fronts. I love it. I wanted to say one term that we're using, we're throwing out, TARP. TARP stands for Troubled Asset Relief Program. And you're right, Peter, it was $600 billion in 2008. And we did it to bail out the financial system, essentially transferring leverage or bad assets from the financial system onto the balance sheets of the Fed. If we had paid that down without any QE taper tantrums, because they were looking at the equity market, oh my God, now the equity market's going to puke again. We got to stop this QE tapering. We have to continue it. And they wanted to stop the debt cycle. Okay, they wanted to stop the credit cycle, which is a periodic cleansing of the economy. They have decided there's going to be no periodic cleansing of the economy. We're going to eliminate the business cycle altogether. And if you want to do that, yeah, the value of your currency will accelerate to the downside.
Greg, let me throw another thing in there.
Okay.
So we talked about it being unpopular politically. If you try and make people take the economic poison of a end of a cycle, you're going to risk not being voted for. Is there another thing here as well? In that, like, we're now in a globalized world. Any of us can buy pretty much anything from anyone in any part of the world. Like, I can buy services from you and pay you instantly online. I can travel to anywhere in the world. So countries now are in a position whereby if they choose to take the poison, that maybe disadvantage them in the global economy versus other countries. It's kind of like everyone has to take the poison together. If this is a global problem, because we're talking about global GDP and global debt these days, unless the world takes the poison at the same time, it's going to put one country at a disadvantage to another, right? Surely that's the position we're in. Am I right?
Yeah, 100%. Especially after we came off the Bretton Woods system, 1971. In 1944, basically after World War II, we agreed. Okay, the U.S. holds all the gold. We won the war. We'll back the dollar with gold. Everyone else will back their currencies with the dollar. Well, that kind of unraveled because game theory, they were kind of cheating the U.S. and other countries as well. So starting in 1973, it was just the whole entire world was free float fiat. We came off in 1971, but they tried to maintain a peg. After that, in 1973, it was just free open market fiat currencies. Well, the incentive there's kind of a perverse incentive where if you debase your currency or, in this case, like lower interest rates, well, what do? You make your exports far more attractive. You suck in a ton of capital into your domestic economy. And so, you'll see a lot of like developing nations, especially, you'll see them like over the last 40 years, if you were a developing nation, what you could do is you could basically debase your currency. You were incentivized to do it, and you spur your economy, right? And so like there's no incentive to just jack up interest rates, because to pay down your debt, because that would destroy your local economy. It's kind of like a race down to zero. That's what the global fiat game is. It's just everybody kind of racing to zero the fastest.
It is actually called, there's a term for it. And Rick Santelli said this famously on TV on CNBC. Rick Santelli being one of the few CNBC reporters that has a spine that can go out and call out the government for stuff like this. He calls it beggar thy neighbor. Okay, you depreciate the value of your currency so that your exports, which is your global balancing, your foreign exchange trade is what balances C plus I plus G. Your economic formula. If you increase your FX trade by debasing your currency or beggaring thy neighbor, it's a short-term solution to your deficits. Okay, and that's the terminology. Dylan, you hit on something that I wanted that you didn't call it out, but you did in an article, an article after your excellent paper. You call it implicit versus explicit default. 1971 was an implicit default of the United States. All right.
What?
You got to call it like it is, guys. They defaulted.
Tell people what happened in 1971.
Well, yeah. What the fuck happened in 1971?
Well, I mean, I know what the fuck happened in 19. So you're talking about coming off the gold standard to pay for Vietnam. Nixon wanted to pay for the war.
That was a default. That was a default.
Yeah.
Let's call it what it was.
Yeah,
it was
exactly
a default.
What you're saying. I'd never thought about it like that, but it was a default because Nixon wanted to pay for Vietnam War, came off the gold standard, and allowed him to print money, devalued. Okay, I get it.
Yeah, so an implicit versus an explicit default. Greg has this long paper about credit default swaps and valuing Bitcoin off of it and all of this. But in a fiat environment, the U.S. government or really any nation that has access to their own printing press is never going to explicitly default. Meaning, if you're a corporate borrower or whatever, if you don't have enough cash flow or you go bankrupt, you're defaulting on your debt. Well, the U.S. is never going to default on their debt. They're going to go the route of Kelton, right? They're gonna print money.
If I could interrupt, though, this is important. What happened in Venezuela? They shoveled that currency to the curb. Is that a default? Yeah, I think so. They pay you in a currency that gets thrown to the garbage heap.
Well, Lynn Alden talks about this. She talks about the fact that the way, she talks about the various ways you can get out of this situation. And one of them she talks about is that, because she talks about the 130% GDP debt to GDP ratio. She calls it the event horizon. Of 52 nations who've been in that position, 51 have defaulted. The only one that didn't is Japan. And she says the way they get out of this situation is they print themselves away. So the bondholders are getting paid the nominal amount, but they're losing their purchasing power.
Yes, except if she adds all debt in the world, with all due respect to Lynn, she's brilliant. It's actually 400%, okay? Because you need to add all
but
debt
she's
in the
talking
world.
about individual
because
nations.
if you have interest,
Yeah, she's talking about public debt GDP.
Doesn't matter. You add it all together in the globe, and even in the USA, she's only taking federal debt. You need to add state, government, local, corporate, unfunded liabilities on top of that. Don't even get to me. Don't even let me get into that. The point is, it's 4 times. It's 400%. It is not 130%. Okay, it's gone. It's over mathematically. Full stop.
We're fucked.
Yeah,
It's
I mean,
over.
hyper
Burn it all
Bitcoinization
down.
essentially, like the next decade. This is the largest wealth transfer ever, and it's going to be from creditors, right? Anybody that's a bondholder, your wealth is going to be transferred to Bitcoiners, essentially. I mean, there's there's a lot of nuance and a lot of things going down there, but if you're a bondholder, you are transferring, not in nominal terms, but in real terms, all of your value to Bitcoin holders over the next decade.
Well, let's quote you again. A great debt jubilee is coming, and it would later be known as hyper-Bitcoinization. That's how you put it. I think that was that your final line on the whole paper?
Yeah. And that's kind of, just another way to say what I just said, is that, so like the only way out from here is just to continue to make lower and lower real yields, right? Like CPI just came in at 5% or 6% or whatever it was. Well, what's the 10-year treasury? What's the 30-year, right? It's like the real yield on those securities is minus 4%.
Let me ask you.
And so the only way forward.
Is it just Bitcoiners though? But like, let's try and balance it out and be fair. What about gold holders? What about people who own property? What about people who own like other hard? Is it all hard assets?
It's not your house going up in value, Peter. It's the fact that the unit of account is going down in value, right? So everyone's saying I'm making so much money on my house. No. If you measure your house price in gold, it hasn't moved. If you measure equity returns in gold, they've been flat over the last 20 years.
Mm-hmm.
But everyone thinks they're going up because the unit of account, of which you're printing more and more of, and it's being debased, that unit of account makes things look like your house is going up in price. It's weird, but it's circular logic again. It's a circular error. If you measure it in Bitcoin, well, it's not even close, right? I mean, everything looks horrible measured in Bitcoin, except Bitcoin, which 1 Bitcoin equals 1 Bitcoin. So, Dylan, you're hitting at all the points again. Yes, it will be bonds, because when you lend someone, Peter, a bond, you lend $100 for 10 years. The US will pay you that $100 back in 10 years. The problem is in purchasing power, 10 years later, it's worth like 65 cents. Hey, that's a great trade, isn't it? A fiat contract, it's good for the lender. It's horrible for it's good for the borrower. It's horrible for the lender. Anybody who owns bonds
right people now, are buying these bonds.
Pension funds who are mandated. It's in their investment committee guidelines. They have to own X amount of their assets in bonds. It's there written in corporate law.
They should mandate them to own Bitcoin.
They don't move that fast, Peter. And by the time they do, Bitcoin will be, currently, as I always say, Bitcoin price right now is still a rounding error. When Bitcoin hits $250,000 and it's still wicked cheap at $250,000, a few of these investment committees may get their heads out of their you-know-whats, and they'll say, okay, now it's time for us to own it. And meanwhile, El Salvador, the world will start to be learning Spanish, because we better learn Spanish because they are so far ahead of the game.
Do you know, it makes me think of that thing. I think it's Preston Pish who says it. Like, Bitcoin is a game of musical chairs. And when the music stops, you want to hold as many chairs as you can.
Okay.
Basically.
I might have not got the quote exactly right. Someone's going to come back in the comments on YouTube and go, "You fucking idiot." Preston said it different. But like, I know it's something like that. Let's work through this. Okay. Because it's not like there's like a point of no return. We've already gone past that, right? There's not like there's going to be one cataclysmic event. So how does this play out? I mean, I'll start with you.
There could be one cataclysmic event. Can I just say there could be a cataclysmic event? Everyone assumes the contagion. What if Argentina defaults again, which they're going to, and that will make 4 times in my life that Argentina has defaulted. In my 30 years of trading risk, Argentina will have held the record of defaulting 4 times.
But we won't be surprised by that.
It's a G20 country, though. It's G20. Canada's G7.
But
Okay,
Greg, I've got this mate, right? He's always, I'm not going to name him. He always borrows money off me, right? And like pays me back sometimes, but most of the time he never pays me back. He's a fucking idiot, right? That's who Argentina. Let's call him Dave. Argentina's my mate Dave, who never pays me back, and I'm like used to it. So let's not worry about Argentina. Let's talk about
who's the idiot, Peter? With all due respect,
I'm the
who's the
fucking
idiot?
idiot.
Him who comes to you that keeps lending him money, or you
Me,
that
but I
keeps
like
lending him
Dave.
the money? I
like
gotta say
Dave.
it.
I
Who's
like
the
having a
idiot?
drink with him. I like Argentina, and I like going there and having a steak and some Malbec. But I mean, I'm not going to be like surprised by, like, if I read tomorrow Argentina's defaulted again, I'm not going to be surprised. If I read tomorrow that I don't know.
How about Canada? What if Canada defaults? Would you be okay? We're in not good shape, okay, Peter? And we're a G7 country, and we happen to be one of the United States' largest trading partners. We used to be. We were, if we're not first, still we're second. The funny thing is, if we default, what would the people in the US say? Oh, well, that's sort of weird, because we always thought of Canada as being part of the United States almost. And by the way, they can't pay any of their bills. So all the stuff that we're exporting to Canada, well, full stop. That's got to stop. And all of a sudden, people in the US go, and why is Canada any different than the United States?
So what you're saying is,
good Lord, why do I own bonds?
You're saying, Greg, we could have like a Black Monday event.
Contagion. You see it all the time. Contagion is the crisis of confidence in the ability of the system to continue. We needed to rescue the financial system in 2008 and 2009, and the Fed did the right thing. The thing they didn't do correctly was pay it down when they rescued the system. They continued to pretend that they could skate their way and eliminate a debt cycle, okay? They did the right thing because the world was ending. I was sitting in that chair, and there were times when I went to work on March 2009 saying to myself, wow, this really could be it. And I promise you, unless you've sat in that chair, you have no idea what it feels like when all you want to do is sell anything you can because your clients are redeeming you. Oh, and there's no price.
Is this a bit like at the end of the big, you know the Big Short, right? Is this like the moment in that where like everyone's trying to sell their shit? They realize the game's up.
I love you, man. Exactly. That's exactly what it is. Hence, credit default swap pricing on sovereign nations. Before it was CDS pricing on financial institutions. I'm just taking it up a level. CDS pricing on sovereign nations is exactly the same as CDS pricing on Lehman Brothers, when Lehman, where the fire started, was in the credit default swap market, and everyone else was like, no, this is fine. The Fed's going to cut rates. The Fed's going to cut rates. And then kaboom.
So all the smart people are basically doing the same with Bitcoin at the moment. They get rid of their dollars.
No, they're not. No, they're not.
Greg, we're the smart people.
I'm saying the smart people.
Okay, how about this? But the smart people that understand credit default swap markets are still stuck in their little, okay, I better figure out how this works. But they haven't done the work on Bitcoin. That's what I'm saying. Nobody has studied it.
Greg, not those fucking idiots. I'm saying all the people who understand Bitcoin, right? This is what we're doing. This is the moment at the end of the Big Short where they're trying to sell. They'll say, I take 30 cents on the dollars. I'll take 50, whatever. We're doing the same. I'll just take the Bitcoin I can get. I'll get rid of my dollars. I'll get rid of my pounds. Give me that Bitcoin, because we don't. There might be one big kind of Black Monday. There might be multiple Black Mondays. There might be a series of events. They're big events, small events. But either way, over the next however many years, we're going to see some form of debt jubilee. It's inevitable. The Great Reset.
Yeah, I mean, like that movie is pretty awesome. Like when Michael Burry's sitting there and he's writing down. He's on his whiteboard and he just keeps marking down more and more losses. Like, I mean, that's kind of what being a Bitcoin holder feels like over the short term, right? It's like, I'm right. I know I'm right, but the market's telling me I'm wrong. But at the moment, like the entire, like mortgage-backed securities, all that junk in the Big Short, that's like the entire fiat system. And the credit default swap is like Bitcoin.
Hallelujah. Hallelujah. And here's the neat thing. That was a movie, guys. Sit in the chair, okay? Your sphincter is tight as a fucking nut, okay? You can't even breathe. You're sitting there, you're sweating, you're like, fucking, my life is over. Everything I have invested in this system, in this business, I'm trying to create, and I have a good track record, but the world is blowing up, and you cannot even breathe. And I promise you, that doesn't come out in a movie. You need to sit in the chair. You need to manage risk. You need to sweat your fucking ass off because you think the world is going to end.
Well, this is the point I keep trying to make. So, like, obviously, over the last year, especially last 6 months, I've had people come to me and they're saying, "Look, tell me about this Bitcoin thing. Why should I be buying it?" And then the last 3 months, it's a tougher conversation because people are saying, "Yeah, but like it went up to 64 and now it's down to 32,000." I'm saying, listen, you're buying Bitcoin for when you need it. You're buying it for that point where when the shit hits the fan. If the price has dropped to 32 grand, that's a bonus. You can still buy cheap because you're not meant to be selling your Bitcoin now. You might be selling it 5 years or 10 years or when you need it. So every time you see a price drop, that's a bonus. Like, you know,
Bitcoin
you might
is
have seen
insurance.
Bitcoin you hold drop in value.
Bitcoin is like house insurance, and the house is on fire, and the agency just called you up and it's like, "Hey, your premium just got cut by 50%," and you're looking at them like, "Why do you just cut it 50%?" The cost of insurance just
Beautiful. Hallelujah. And when do you buy default insurance? Oh, excuse me. When do you buy fire insurance, Peter? Real fire insurance on your house right now. Not when your house is on fire. You buy it before your house is on fire because no one will sell it to you. Rational people will not sell it to you when your house is already on fire, except people don't understand that the house is already on fire.
Do you want to hear
Dylan is exactly right. You're getting cheap insurance.
Do you want to hear a funny story about that? So my house was literally on fire about 3 months ago. I was down the gym with my son, and my neighbor phones me and they said, "Hey Pete, your house is on fire." I was like, "What?" It's like, he said, "There's like a fire at your house." So I come home, right, and my next door neighbor, he's basically emptied his chimney 24 hours after like lighting it. He's put all the ashes into the bin, thinking he's fine after 24 hours. Something sparked. There's been a fire. The bin's caught on fire. The side of his house is on fire where there's a door, so like the fire's gone into his house. My side is burnt down all the fence and my bikes. Luckily for me, there's no doors and windows on that side of the house. So anyway, he gets in touch and he's like, "Oh, I need your insurance details because you have to claim it on yours. My insurance company will pay you." So anyway, I go up to phone my insurance company and I get in contact and they're like, "Oh yeah, you cancelled your insurance 8 months ago." So basically, my house was on fire and I didn't have insurance. How funny is that?
Could have been worse.
Like, dude, I tell you, I was lucky I didn't have a window or a door that side, and my house would have burned down. But anyway, I have house insurance now. What a fucking idiot. Anyway, that was a.
So can I just, so going back to the Michael Burry Big Short, Michael Burry was right because he's mathematically inclined, okay? The truth is the financial system is always over-levered, and it's leverage unwinds that cause the ultimate pain. Okay, you're sitting there thinking the world's going to end. If you're short, meaning you own insurance, you're short the markets, you're still nervous because you don't know if you'll be able to collect. Because the guys that owe you all this money, they may go out of business. Like, what if you owned insurance on Lehman Brothers, but you had bought it from Bear Stearns? Geez, you're like, I better go and buy some insurance on Bear Stearns because they're going down as well. So that circularity contagion expands. And then you realize Bitcoin has no counterparty risk. Nobody has to guarantee this insurance policy to me because it's called Bitcoin and it can survive a nuclear war. Maybe. Look, who knows? Let's not go that far. It can survive anything. We've seen it. It survived over time. It is anti-fragile. It is a thing of beauty and it has no counterparty risk. That is what you want in an insurance product. Okay. And
yeah, I mean, I think about it a lot, and especially after reading the Ray Dalio's books and all that about, you know, like past debt crises and whatnot. The solution to it in the past, you know, the past centuries was always gold, right? It was in, you know, when you're at this point in the long-term debt cycle, you know, you want to protect yourself from a couple different things. You want to protect yourself from the central bank monetization, where basically if you're holding bonds, if you're holding cash, you're getting diluted. You're getting your wealth inflated away. But you want to protect yourself from the counterparty risk that's, you know, that comes with deflation, with contagion, what Greg's talking about. You don't want to hold anything inside of the banking system because the banks or any financial institution might go bust, right? So you don't want to have any sort of counterparty risk. And I think about it a lot. I'm like, if Bitcoin wasn't around, like, God, would I be a gold bug? And like, I probably would. I probably would hold like a fair amount of gold. Like, it's kind of depressing to think about, but you know, Bitcoin is just that monetary asset that bearer asset that has a production cost that has no counterparty risk, but for the digital age, for the 21st century, that's Bitcoin. And regardless of if there's inflation, deflation, contagion, there's always going to be, because of that proof of work algorithm and because of the protocol, there's a production cost to producing Bitcoin. You cannot dilute my wealth. And unlike gold, the terminal inflation rate of Bitcoin is 0.
Well, let's dig into that point again. I'm going to quote you again. The great debt jubilee is coming, and it will later be known as hyper-Bitcoinization. Let's dig straight into that. So I think it's a good place to finish off, because people listen to this. It's a range of people. We're going to have like absolute Bitcoin heads who put all their money in, and like crazy psycho Bitcoiners, and they get it, right? They're in. And we got some people who've maybe been in for like a couple of years, and maybe they got like a good chunk of Bitcoin, and they're like, but it went up to 60 and it's come down to 30. I'm a bit worried. And then we've got the people who are just brand new. They're basically underwater with their Bitcoin right now, and they think, what the fuck have I done? I should have bought Dogecoin. Like, let's kind of like set the record straight here. Explain, Dylan, what this great debt jubilee is, like how it's going to play out, how you think it may play out, and why Bitcoin is the answer.
Yeah, so I mean, there's a couple different ways it plays out, or could play out. There could be, like Greg said, this large contagion event, deleveraging, and there will be. But the thing that you have to think about is, how does it play out after that? And in my opinion, it probably plays out with central banks, governments around the world monetizing everything. Like the Fed balance sheet in 2030, who knows? It might be $100 trillion. And so a great debt jubilee essentially is creditors getting their wealth wiped out in real terms, right? You're going to get paid back on your 30-year or your 10-year government treasury, but what is that value going to be worth? Well, I don't know, but in my opinion, and mathematically speaking, it's most definitely a lot less. And so, as a Bitcoin holder, as someone that buys every day regardless of price, I know, because of how network effects work, because of the protocol, because I can run my own node, and I have complete assurance of 21 million. I know that honestly, the volatility of Bitcoin for me is 0. Like, Bitcoin's my unit of account. Like, volatility doesn't matter to me. And so, obviously that's like a tough mental switch to have, but hyper Bitcoinization is essentially that process happening around the globe. And it, happens one by one, and, day to day, it's almost like painful sometimes. Like, it's happening slow, or like, why can't people get it? But over time, there's just kind of this Schelling point where people realize that Bitcoin is the best monetary asset the world's ever seen. And one by one, people are realizing that. You'll have your Hankies, you'll have your Peter Schiffs, you'll have people with ego problems that get upset by this. I missed the boat, and they'll think they missed the boat for year after year after year. But there's just kind of this empirical reality that Bitcoin is the best money the world has ever seen. You had a great episode with Parker Lewis the other day. Parker's the man, and he articulates it, as good as anybody. But Bitcoin is just this, like, is Bitcoin the best monetary asset the world has ever seen because of its assurances? Yes. Well, I mean, essentially, you can almost end the conversation there. There's a lot more to it. There's a lot of nuance, and how does this play out? Well, you can understand that, or think you understand that, or not. But the reality is that Bitcoin will outcompete every other money going forward. And so, if you're just accumulating Bitcoin on, in cold storage or on your balance sheet, you're going to be okay. And your real wealth over the long term is going to be protected. And at this point, during the monetization process, is going to increase 10, 100, 500 fold maybe.
I need more Bitcoin, brother. Every time I have a conversation like this, I'm like,
here's what a neat thing from a boomer. Okay, so I'm the boomer, and you need to understand firstly that the boomers have all the money still. All right, and when I say boomers, it's the guys that manage the big wealth, sovereign wealth funds and pension funds around the world. That they have not even begun to invest in this asset class. Okay, they don't understand it. They haven't done the work, and when they do the work, they look to their left and they say, dang, I don't want to be the guy that goes out on the limb and says that I'm doing this because nobody else is doing this. So it's called the theory of agents. They try and stay within their own lane because everyone's doing the same thing. But it's going to come where they own more than 0, Peter, but not 100% for their wealth or their fund. They cannot possibly do that. But what is the right number? According to Yale University, the right number for anybody who owns bonds and equities is to own 6 to 8% of your asset allocation in Bitcoin. That's a huge amount of money that needs to flow into Bitcoin to achieve the optimal portfolio allocation as a function of its volatility and its return potential. Okay, perfect. Most of these guys are at zero. If they were smart, it's been halved in price. It's come from 60 to 30, and it's still a rounding error based on where it's going to go. They just got to get that through their head. Bitcoin is not digital gold. Yeah, it is digital energy. And every single thing in human history has been based on improvements of energy and energy productivity. Well, Bitcoin is the purest form, as Michael Saylor says, of digital monetary store of value ever created by humans. Okay, let's talk in 20 years. 20 years, not 20 days, 20 weeks, 20 years, because that's when the horizons of most pension fund allocators are. And that's what they need to focus on. It's empirically reality or empirical reality, quote unquote, Dylan LeClair, sub 20-year-old. Are you 20 yet, Dylan? I think you were 19 when I last met you. So,
Yeah, 20 years old.
okay, buddy, I'm 3 times your age.
Fuck,
Okay.
man.
I'm 3 times your age, and you're
I'm
3
twice your
times
age.
smarter
It's
than me.
bullshit.
You are 3 times smarter
Yeah.
than me, and I love you because you are going to rescue the world. Because my generation is the most selfish generation ever put on earth, because we're too afraid to take a loss, and we need to be coddled. And God forbid we ever had to go fight a war right now. I don't even know whether we'd be able to get an army together. And Canada used to
Fucking
have...
boomers.
It's fucking boomers is right. A bunch of lazy,
Fucking
sappy,
boomers.
fucking spineless squids. Okay,
Yeah, they fucked it
and
up
I'm
for all
one of them.
us.
And I'm one of them.
This
Yeah,
is Dylan. This is why you can't afford a house, because of this guy. And you should listen. You're twice my age and about 48 times smarter than me, and it's impressive to hear.
Appreciate it. Yeah, I mean, I don't think it's much about me, more about like I'm here, like I kind of fell down the rabbit hole because of like the incentives, right? Like Bitcoin like pulls everybody in, and you figure it out. Like the curious and the people that are willing to drop their ego are going to figure it out. And that's just like the incentives of adopting a harder money. Also, kind of wanted to comment a little bit on like what you were talking about, Greg, with like portfolio allocation. A lot of people, like, what they don't understand with Bitcoin is like if an equity doubles, right? Like nothing really, no earning increase or whatever, and an equity doubles or triples or quadruples in price, it becomes more and more and more risky, right? The higher the PE ratio, the riskier it becomes. Well, with Bitcoin, when Bitcoin doubles in price, when Bitcoin 10x's in price over a 4-year period, it becomes less risky to allocate to. And that's what like a ton of people don't understand. As Bitcoin increases in liquidity and size and global dominance, it becomes a less risky add to your portfolio. And you can think about that in, risk adjusted returns or volatility or all this thing. But, Bitcoin at $1 trillion is a lot less risky to allocate to than it is at $1 billion or 10 billion, right? Like, and so, like all of the big money as Bitcoin goes from 32 to 64 to 128, it's just like naturally it's going to become a bigger and bigger, part of the people's like asset, the right side of their balance sheet. It's gonna naturally become a larger, percent of people's holdings around the world. And the big money can allocate a little bit later. They can afford to. For me, I'm 20 years old. Like, I'm putting 100% of my disposable income into Bitcoin and not thinking twice about it. Like, I don't care if it gets cut in half, like that's just kind of my, like, I guess if you want to call it like a risk profile, like I don't perceive it as risky. And I'm fine with it getting, like, send it to 10K. Like, I'm still allocating, like the thesis is unchanged, like, and so, yeah, I think, it's just it's a process, but Bitcoin, as it becomes bigger and bigger and bigger, a lot of people haven't adjusted to that.
Can I add this too? And that's beautiful, Dylan. Peter, I was lucky enough to get involved in Bitcoin. You call it lucky. I tend to think I did some work. It was under $1,000 US. Bitcoin's a better investment now at its current price than it was when I got involved at under $1,000 US. All right. The 5 years that the system has proven itself, the network has grown, the talent in the network has grown, the protocol is more robust, the layer 2 is real life, layer 3 is coming. Bitcoin the layer 3 on Bitcoin could absorb all the successful DeFi apps that are currently living on other blockchains. Okay, it's just unbelievable what this could cause in growth. Doesn't matter. The base layer right now is better value than when I got involved 6 years ago, and the price was under $1,000 US per coin. I am more excited about the return profile of Bitcoin today than when it was under $1,000 a
I get
coin.
that.
Very simply because it is the network effect. The value of Bitcoin is the network. And that network is growing with use cases growing every day. And then if you want an intuitive value, Bitcoin is default insurance on every single idiot fiat nation out there, okay? Which is pretty good insurance to own because they've proven over time that they are a bunch of buffoons. And if you want to keep your money managed by buffoons, go ahead. Then who is the buffoon? Maybe it's Peter, who keeps lending his money to his friend Dave, who never pays him back.
Listen, Dave, look, if you went out for a beer with Dave, you'd lend him money. He's good value.
Then I would, but then I wouldn't lend him money. I would just give it to him. I'd say, Dave, here's some money. And maybe that's what the governments are doing to us now. Hey, Foss, here's some money. And I'm like, I don't want your money because every time you give it to me, you'll fuck it up.
I'm giving Dave stimulus checks, really, aren't I?
You may well be.
Fucking Dave. All right, listen. Look, this has
I
been
love
great.
Dave. I don't know Dave, but I love Dave.
He's not actually called Dave. I'm not going to give his real name. Actually, he doesn't listen
Okay.
to this because he doesn't get Bitcoin. All right, listen. Look, this has been awesome. I'll tell you how I want to close this out. I want to close this out quite differently. It's been a great show, Dylan. Great to have you on, man. You're smart as shit. I'd love to have you back on the show again in the future. But Dylan, I'm massively fascinated by the fact that you quit college. You've built your education up. You've become very, very smart and educated around Bitcoin and how the economy works. Like, just for anyone listening who's in a position they're thinking, shit, I like what this Dylan guy's saying. Point them in the direction of some of the things like you've read. You've mentioned the Ray Dalio book. What are the things you've read? What are the things you would say go and check out, go and listen to, go and read?
Yeah, I mean, so like I kind of started stumbling upon podcasts, your podcast, Preston's podcast, a bunch of others, read the Bitcoin Standard, like the bullish case for Bitcoin, the Nakamoto Institute, all of that stuff. And like my decision of dropping out of school, like it's totally not for everybody. You know, if you want to go be a doctor or anything that actually like requires a degree, like I'm not telling you to go drop out, but I would just say, especially kind of once you kind of come to understand Bitcoin, for me, it was about measuring opportunity cost in Bitcoin. It was about like Bitcoin was $6,000 and I was sitting there in March or April, like clawing my eyeballs out and saying like, what am I doing here? I need some sats. I need some Bitcoin. So like, I would just say, like the opportunity cost is real, like going to college, like none of these decisions occur in a vacuum. And just like, for anyone that's 18, 19, 20 years old, education is, and I was really inspired by Jeff Booth's book as well. Like education is free, information is free and abundant. And so, don't discredit that. A lot of things can happen and the internet is a wonderful place. I've made so many awesome connections over Twitter, YouTube, everyone else, just by sharing my thoughts, asking questions, hitting people up in DMs. Don't think that you have to go to a university or get all this, credentials and all that nonsense to be someone or something or make it, because it's not the world we live in. And the sooner that people figure that out, the better.
Love it, man. And listen, Dylan, if people want to follow you, where do they find you?
Yeah, you can find me on Twitter at BTCization, Bitcoinization. My name's Dylan LeClair. Just reach out, hit me on DMs. Happy to connect.
Brilliant. Well, listen, I'd love having you on. Come back on soon, brother. If you work on another thesis or idea you want to do, like you've got an open invite to come back. I've loved this. And Greg, any final closing notes from you, my man?
Very simply, I love the young guns. Okay, I'm going to shout out to Jack Mahlers, a shout out to Dylan. I want you guys. I know you wouldn't take this job, but I want you guys to run.
I'm still young. What the fuck?
Okay, dude, but you're young, you're beautiful, but you're just not quite as young as you need to be. Okay, I want these young guns to run the world, and you're gonna someday, whether that's an aspiration or not. I want to make two final call outs to the young people changing the world. The kids in Guatemala, again, I mentioned them in Miami, the Guatemala, the IBEX exchange. It's beautiful what they're doing. And now they got called into El Salvador as like the SWAT team because they get the Lightning Network. This is exciting. And then the final call out. So that's IBEX, that's Jose, and it's Mario, and it's Carlos. Here's a final shout out to you, Peter. And this is important. Some young man from London, England, Oxford to be exact. Now, I don't know if he goes to Oxford University. He called me the other day on Zoom and he goes, I'm doing this Bitcoin exam and I want to help teach the world using an online Bitcoin exam. And I'm like, well, dude, this is brilliant. Yes. And he ran me through the beta test and everything, and I gave him some impact, some viewpoints that I had. But what I see is another young man who's 20 years old. His name is Stefan Allen.
Mm-hmm.
He might have, if I'm not mistaken, 25 Twitter followers, Peter, and he lives in your backyard. And
What?
he has developed
Let's
this
get him
Bitcoin
26.
exam that is brilliant to allow people to understand, do they need to study more? Because it's not a simple exam. And there could be different layers. You could be beginner, intermediate, or expert. The point is this. It's about, like Dylan said, education around the world. So a shout out to you young guns, okay? I hope to be around for the next 20 years. And I hope to talk to you in 20 years so we can create notes or compare notes. But what I will say is my 3 kids will be around in 20 years. And I promise you they're going to be comparing notes, okay? Bitcoin is not for my generation. We fucked it up. Bitcoin is my generation to make it work so we can pass something to future generations with value and store of wealth. Amen to people like Dylan and the young guns, and amen to you, Peter, for having a platform that the world listens to. Okay, so thanks for having me on, and I look forward to the successes, and I look forward to the next talking in again 20 years.
Yo, Pete, can I plug one more thing?
Yeah, sure. Brother. Do it.
I do with Bitcoin Magazine. I've been doing a newsletter with it's called the Deep Dive. I just put out my thoughts every day on working with them on macroeconomics, on chain, kind of derivatives, what's happening in the Bitcoin market. I know I believe Greg has a sub there, but that's what I've been working on lately. So yeah, I just wanted to give that a shill.
And it's brilliant. It's brilliant.
Greg, do you know who this Stefan Allen is on Twitter? I want to find him and follow him.
Okay. I have his. Okay. If I lose you here, I'll DM you because I'm a neophyte with this new technology called a computer. Okay. So
fucking boomer. Listen to him.
I am a fucking boomer, buddy. I love it. Now
I'm gonna follow him.
So I'm gonna go here.
I want to follow him.
You got to follow him, and I swear to God, I want this to succeed. I actually want it to be done in Spanish too. So I reached out to the boys down in Guatemala, and they sent me a beautiful response email today. And they go, "You should see all the great things that are happening in Guatemala and El Salvador." By the way, so that's a real life update from boots on the ground. Okay, so Stefan Allen, hold on.
Well, listen, look, we're going to bore the listeners. You can ping that out to me. Love talking to you, Dylan. Anything you need, you reach out to me, brother. Greg, same as ever. Love you, brother. Hopefully, I will come and hang out with you at some point when Canada opens up, if it's any time in the next decade. Peace out. Thanks for coming on.
Thanks, Pete. See you guys. Peace.